sized as long-term with a short-term takeout. Exactly right. Why does it exist, right? So mini-perm debt exists because it's really difficult for some lenders to hold long-term debt on their books. And so mini-perm is short-term debt dressed up as long-term debt. Okay, and Francisco said it really well. It's debt sized as a long-term debt, but with a short-term takeout. Okay, so we're going to just look at some of the stuff around mini-perm, and then we're going to look at how we might model it. So let me just quickly share my screen. I only have a couple of slides, and I'm not big on a lot of talking to slides. I'm absolutely passionate about modeling, so I love to get stuck into the modeling. So we're going to look at a model. But let me just quickly share a couple of slides with you. Can you now see that screen with slides on? Tobes or Tia, give me a thumbs up. Awesome. Right, mini-perm debt, what is it? And if I keep looking over here, it's because my screen with the slides is over on this side. So yeah, we talked about it. Let's imagine we have a 25-year project, right? Then what we're doing is we have a theoretical tenor for debt sizing. Exactly as Francisco said, it's sized as if it was long-term debt. So we would be looking at, because, you know, infrastructure, project finance, it just doesn't work on short-term debt, right? We need long-term debt to make the economics work, but lenders struggle to lend long-term. So it's got a theoretical tenor for debt sizing. So let's say, you know, we have this kind of no refinancing case, right? We imagine what the project looks like without a refinancing over, let's say, 20 years. But in actual fact, a refi does happen, right? And there's a terminology of kind of TRD, a target refinancing date. Matthias is here. He's gone topless for the occasion. That's awesome. Thanks, Matthias. It's great to see that. That we've got a target refinancing date 4 years in. And then there's a difference between a hard mini-perm and a soft mini-perm. If we get to the target refinancing date, let's say that's 4 years in, it varies, but we can talk about that timing. If the refinancing fails to happen 4 years in, then the project's in default. So the project has got to refinance, you know, 4 years in. In a soft mini-perm, the project is not in default, but a cash sweep will kick in. Okay, so over the, you know, once we get to that refinancing date, if we fail to refinance the project, we're going to get into a cash sweep. And I'm going to show you that in the very simple worked example model as well. So if the cash sweep kicks in, then we're going to be all available cash is going to go into pay down that debt as quickly as possible. That's obviously going to be quite painful for the project sponsors, for the project equity. But that, you know, that's how the structure works. And we can think of it as having kind of two potential options. We might refinance the debt on what we call a replacement basis, where, you know, the refi debt comes in at the refinancing date and just, you know, dollar for dollar replaces the existing debt. But if we're 4 years in and we've paid down some debt, we might have some capacity to re-leverage a bit, right? So we might be able to actually leverage up again at the refinancing date and extend the debt tenor. You know, we still have 5 years, you know, at the end of the project. We might be able to push the tenor out there and the debt. So you can see that could be beneficial for the project economics. And if we're in a bid situation, we have to think about, how do we take that into account in our bid? Do we imagine a re-leveraging happening at TRD, in which case that's going to have a boost to IRR, which may mean we can bid at a lower price, knowing that that's a risk, because that we may not get those terms at the refinancing date. And so we have to think about whether we're re-leveraging or replacing the debt. So that's the kind of basic structure, right? And a few of the variables that are going to be in there. So some of the variables we're thinking about is the original debt sizing over the 20 years, let's just say, right, over the term for that original refinancing, and then what we're assuming about the refinancing debt 4 years in. So that's kind of just basic concepts. Any questions or comments so far? Tobes, any thoughts?
Yeah, I was just going to open it up to people think, why would at that point of refinancing, Kenny said we've got 20-year amortized profile with a 25-year project life. Why would we be able to extend the tenor to somewhere between 20 and 25 years? Why is that the case? Why could banks not do it, earlier?
Well, I mean, it all just depends. It's an assumption we're making about the refi. The thing about the refi is we don't know what's going to happen, right? We're making assumptions about what might happen 4 years out, and it might be even further 4 years out, because that's 4 years from COD. So let's say it's a 2-year construction. That's 6 years from now. We're making an assumption. I don't know you, but I'm very reluctant to make any assumptions about the world, like what's going to happen next week, let alone like 6 years from now. But we might assume that if there's a 5-year tail there already, that we can maybe extend that debt a bit further, right? We might make that assumption. We assume that since we're got a project that's 4 years in, well past construction, we might be able to get better terms, certainly better debt sizing terms. But we don't know, right?
And Kenny, I was just going to say, I mean, that's the key thing is, for everybody involved in a project, once you pass construction, you've got an operational asset. You've got something which is generating cash flows, and so your risk profile would hopefully have massively reduced and actually potentially improved. If you're operating your asset really efficiently, you might be generating better cash flows than you originally forecast in your bid model. So, a lot of the risk is gone.
Yeah, exactly.
I had a question. Can I jump in? Oh, sorry, go for it. Hello?
Hi, go ahead, Mark.
Yeah. How are you doing? This is my first event with you guys. I'm having just kind of putting input. If you want to do a financing project, are you going to talk about construction supporting the contractor, or are you going to support the investor? Because the investor is the longer, as 20 years might be, yes. But if you are talking about a contractor, the contractor may be the contract. Like I've done many of them. It's like like in Dubai, the highest, tallest building, it will take around 24 to 30 months. So that's everything at the moment. So this is considered as like in the contract financing, and that is based on milestones. You need to, focus on the contract, the bill quantity, the submittals, the equipment, narrow down about what equipment you're going to purchase by LC, by overdraft, and you can put like in the contingency margins about from cash regarding covering your employees, for example, and getting bottlenecks, especially at the beginning of the project, because you have having performance bond to be submitted, and that's can tie a lot of cash. But when you talk about real estate investments, this is different ball games. The bank cannot expect at least 1 year operational as a grace period after the constructions of the investments is being done and is going operational. So once operational, you can have a grace period operational period, and you can have a payback dates for that specific real estate. So it depends about the financing is defined what project it is and who is your client, isn't it?
No, absolutely. So absolutely project specific, and I'm talking particularly about project finance when I'm talking mini perm here, as opposed to real estate. And I know things are different in real estate, and it's not actually my area of expertise at all, real estate. I'm much more involved in PF stuff. But yeah, it's very much varies by.
Actually, I worked in both actually over 9 years.
Cool. Thanks for that, Mayor. Alex, you wanted to interject.
Sure. My question was, if the yield curve inverts, how does this impact prospective refinancing terms?
Great. Can we circle back to that towards the end? Because I want to get to the kind of crux of the mechanics of this, of how this actually works. But yield curves are going to affect swap rates and overall price of debt. So that's going to have an impact on debt capacity and refinancing capacity at the different points. Hedia asked a great question on, do you assume refinancing in the base case when using the model for setting the tariff during bidding? And that's a really critical question, Hedia, and I'm going to talk about that as we look at the model. So I just wanted to share with you a really simple worked example so you can see how you would model this. What does this look like? So give me 2 seconds to do the flailing around of screen sharing, and hopefully you can see a model on my screen. Can you see that now? We're seeing the model? Brilliant. Let me just move some of the Zoom crap out of the way. 1 second. Oh dear, where we go. Let me just move this because it's taking up my screen. Right, okay, and move you guys over there. Okay, so what I've done is put together a super simple worked example. As you can see, this model only has like 15 inputs or something, right? So basically, it's imagine we've got a 25-year project. We've got a tariff of $1 per unit and we're making 100 units, right? So it's super simple. If we look at the financial statements, we can see that our revenue is 100 a year. It's a yearly model. And I haven't even modeled construction. So I'm just modeling kind of the fictional operating period of a project here. Super simple, revenue of 100, OPEX of 20, EBITDA of 80, right? And if we look at the cash flow statement down to EBITDA, and then we've got cash flow available for debt service. So what I'm imagining is we've got a 20-year mini perm. So the notional tenor for debt sizing is 20 years. And the debt has been sized at a 1.4 coverage ratio at 5% per year interest rate and a target refinancing date, which is 4 years in. Okay. And our mini perm, our refinancing is on a 16-year debt, also at 1.45%. So what does that look like? Well, let's just quickly look at our financial statements, and we can see our cash flow here, right? The first 4 years, we're servicing debt on the mini perm debt, on the original senior debt, and then we have the refinancing. So we draw down a certain amount of debt to repay what's there, and we use that to repay the mini perm debt. Now, I'm not taking into account anything like refinancing fees or swap breakage costs or anything just now, just keeping it super, super simple. So if we look at the debt balances, and these are, very, quick and dirty charts, right? This is a very simple worked example model. The original refi debt is paid over 4 years. It's paid off. And then the mini perm, the original mini perm debt over 4 years, and the refi debt is being paid off. So that kind of makes sense, right? Because if we had the 20-year debt, right, it would have a certain profile. If we refinance that at year 4 with debt that has a 16-year profile, then the profile is going to be exactly the same, right, as the original debt. So we can see here, if we hadn't have refinanced, that's what the shape of the debt would be anyway, right? So it's kind of replacing the debt with exactly the same terms. Okay. And what I want to get to when we talk about the modeling is there's some complexity in the modeling of this stuff, because generally that's not what we assume. We don't assume that the refi debt is an exact, let's say, replica of the debt terms of the original mini perm. And it's to Hedia's question is, what do we assume about the refi, and do we include it at the bid? Let's just imagine that actually, instead of having, a refinancing at year 4 with 16-year debt, let's say we go 18 years, right? So we can push that out a little bit further. Before we do that, let me just show you where we are in our outputs, right? So currently we've got 7.57% IRR in both cases, without the refinancing and with the refinancing. And we've got 1.4 coverage ratios, which makes sense because we're debt sizing at 1.4. If we push that out a bit, let's say to 18 years, and let's say we assume we're going to get debt that's sized at 1.3 and not 1.4, and let's say we assume that the cost of debt is 4%. What do you guys think is going to happen? How is our model going to be different if we size the refinancing on a longer tenor at tighter ratios and a cheaper cost of debt? Andrew says we're going to increase the IRR. Absolutely. I think that's exactly what we're going to do. So let's have a look, just quickly solve this model, just because there's a couple of circularities in it. And so now let's look at our debt balance, right? So we're refinancing on a slightly longer tenor, We're not just sticking to the 16 years we had originally. It's slightly cheaper debt, so that increases debt capacity, and the ratios are tighter. So if we look at the outputs, we can see now that our IRR with the refinancing has gone up by 1.48%. Our ratios after the refinancing are down at 1.3. And if we look at our cash flows, we can see now that we're still paying off the 603 of original debt, but we've increased our debt capacity. So we're now drawing 749 of debt. And that's meaning we can make some bigger distributions. So let's just compare, because I want you guys to understand some of the mechanics of this, so that if you have to model this, you're not starting from scratch, right? You've got a sense of, oh yeah, I know the basic structure here. Let's look at CFADs. This is a chart of cash flow available for debt service. The orange line is the cash flow available for debt service when we didn't have a refinancing, right? And that's the cash flow that we use to size the original debt. When we have the refi, we have a slight reduction in CFADs in the early periods. Any thoughts as to why that might be? And once again, I'd be super grateful if you could put yourselves on mute. It'd be really helpful. The background noise is a little bit annoying. Could you go on mute? That would be awesome. Any ideas? Why would the CFADs have gone down when we had a refi? And this is an important distinction to get when it comes to modeling mini-perm debt, and I'll show you why in a second. So increased debt service due to increased debt drawdown, but if we look at the financial statements, cash flow available for debt service is above the debt service, right? It comes before that. So increasing debt service, well, that comes below that line. So it's not impacting that line. There's only two. So Andrea's saying from the tax shield, perfect, right? EBITDA hasn't changed. We haven't changed anything about our operating parameters. So the only thing that can have changed is tax. Let's look at the debt service. When we had this refi, debt service has gone up. So if debt service has gone up, why would our tax have gone up? So I'm looking at a chart of tax. Tax has gone up, which explains why CFADs has gone down. Debt service has gone up. Curious, right? So this is why we need models, right? Because we need to understand these dynamics of what's actually happening. The interesting thing here is we look at the shareholder loan interest. This was the shareholder loan interest before the refi. Now it's suddenly just dropped because we're making a big shareholder loan repayment. Now, that's a huge assumption, right? It's a very simplified model. We're assuming that we can sweep all the available cash to the shareholder loan. Therefore, we're paying the shareholder loan off much quicker. Therefore, actually, our amount of interest deduction through the tax calc has gone down, and tax has gone up, and cash flow available for debt service has gone down. Why am I laboring this point? It's because it comes down to how you need to set your model up if you're modeling mini-perm debt. Because if you model the original debt facility off your new CFADs line, you're going to get it wrong, right? Because the act of refinancing changes the tax, which changes the CFADs, which means if you use that line to model your original mini-perm debt, it's going to be totally wrong. And for that reason, we recommend a kind of a parallel financial statements approach. So you see here, this is my financial statements with the refi. We would always now, when we're modeling mini-perm debt, have a separate financial statement in the model with no refinancing, right? So this is the theoretical project for debt sizing purposes with no refinancing happening. So the mini-perm debt lasts for the whole 20 years and there's no refinancing happening. And that way, if we've got both of these financial statements, we're using the no refinancing one to assess our debt capacity for construction debt in our first 4 years of mini-perm debt. And then we're using the refinancing financial statements for debt sizing the mini-perm refi. And so that's what I wanted to kind of get across to you guys is is if you start with one set of financial statements, you're going to get your debt capacity calculation wrong. And we'll be really happy to share the stuff after the call. So yeah, that's kind of, what I wanted to kind of share with you guys is how we think about modeling this stuff, and then how we're going to think about some of these risks. Because to Hedia's point, what do we assume in our bid, right? We need to assume the refinancing is going to happen. Do we assume the somewhat conservative, we just replace the debt at the same terms? We could do that, but we might lose the bid to somebody who takes a more aggressive position. Or we could assume something more aggressive, but recognize that that's equity risk. Because if we fail to refi on those improved terms, then we're not going to hit this higher IRR, and we're going to take, equity is going to take a hit on that. Okay.
Kenny,
yeah.
I was going to say, just for everyone else's benefit, would you be able to put in that latter scenario where, let's say, we want to do a downsize and say, what if we end up with more adverse refinancing conditions, more expensive debt, and just see what the impact is on the IRR? Well,
let's go back to where we were before, right? So kind of replacing the debt. Let me just solve this. Now, when we're going back to a replacement debt size, let me just get that in place. Okay, so it's got a few things to solve, right? So when we're on replacement debt, the model has got to kind of figure out the cover ratio for debt sculpting. So we're back to where we were. So we're replacement debt. If we go back to our outputs, we're at 7.6%, exactly where we were. What happens if the terms are a bit worse, right? So if we can only get, say, 15-year debt, right? And let's say it's at 6%. Okay, let's run that and see what it looks like. Okay, so now if we go to our outputs, what's happened? Well, our IRR has gone down, right? So our debt balance is being paid more quickly, and our IRR has gone down. Our coverage ratios have gone down, right? So if that's the case, we would be hitting a coverage ratio of 1.27, which would be, which is lower than our original debt sizing coverage ratios. So you can see that this would, if we fail to get that kind of, if we get worse terms at the refinancing date, then our IRR is going to go down. What we'd be modeling now is kind of our expectations of what's going to happen in the 4 years. So yeah, it's tricky to know where to hit that, in terms of what we assume at the refinancing date. And then the other thing to say is, if you're setting up your model to be able to model a refi, the other thing you're going to have to include is the cash sweep, right? So what happens if we don't refi, because lenders are going to want to see that scenario, right? So let me just activate that to see what that looks like in the model. And again, going to come back and just solve here. Okay, so in that scenario, what does our debt balance look like? Well, obviously there's no refi anymore, right? Which is, by definition, what's happening here. And you can see that the debt balance is coming down a lot quicker, because if you look at our financial statements, we're now sweeping all available cash. We've got the mini perm is continuing, and we've got our scheduled repayment. So this is what we're contracted to pay. And then on top of that, we've got the cash sweep payment. So for a number of years, all we're doing is paying down that debt, and there are no distributions until the debt is paid down. And if you look at our output, you can see that that's taken us down to a lower IRR by all that cash being swept. So yeah, that's kind of another thing we need to make sure that we include in modeling a mini perm. And I always find it really useful to have a simple worked example model, so that, I say there's not much to this model. We've got a number of tabs because I put together a bunch of charts so we could see what was going on. But in terms of understanding something, I always find it much easier just to create a really simple model so we can see the dynamics at play. So yeah. So I mean, just looking at some of the questions, Gerald asked, why would we want to refi after 5 years, presuming debt is paid off? This is for a project, Gerald, where you need much more debt capacity than you could get from 5-year debt. Mini perm, if you already have 5-year debt, you wouldn't be thinking about a mini perm because it's already short-term debt. This is where the project needs the debt capacity of long-term debt. But as we talked about, lenders struggle to hold long-term debt. I mean, that's a huge generalization. There's definitely long-term debt available in the market, but this is kind of specifically on the mini perm structure.
And I was just going to say as well, Kenny, some of these things, there are subtleties, like you might be able to get an increased refinancing amount, but say your margin might be slightly higher, and you'll have things offsetting, so you can get cash out earlier and potentially boost your IRR. But you know that could be good, but you've got longer term interest costs and all of these. Right. It's lots of dynamics at play.
Yeah, that's exactly right. And that's why we were playing around with the model, because we'd be looking to see what moves the needle, right? Is it the increase in debt tenor? Does that move the needle? Is it the improved cover ratios? Is it getting the lower margins? That's exactly why we model this stuff, right? Because we want to understand what moves the needle, so that when we come to negotiating those refinancings, we can be getting the optimum solution. Alex is asking, do cash sweeps only happen if we have a hard mini perm? Cash sweeps happen in a soft mini perm scenario if you fail to refinance, right? And so we just look at the cash flows here. If we fail to refinance at the 4 years in, then that's when the cash sweep kicks in. And why does it kick in? Because lenders want to ramp up the pressure on the project to refinance. So as long as we're in this situation where all available cash is being swept to repay the original debt, then lenders are going to have, sponsors, project owners are going to have a much higher incentive to get the refinancing done. And presumably it's not because they didn't want to do it that it hasn't happened, but it's just it's a contingency in the debt package in case the refinancing doesn't happen for whatever reason. Because as we talked about, who knows what may happen in 6 years,
There's a question there from David, which I'm happy to pick up.
Yeah.
Talking about if we can just drill down a bit more on the commercial drivers for mini perm debt in markets where long-term private finance or debt is available, what would drive lenders to propose mini perm debt instead? Well, having been a former banker, I mean, one of the things I liked about mini perm debt was, one, it helped short-term liquidity, but every time I refinance, I'm getting a big fat chunk of arrangement fees. So actually, it's quite good in that sense. You put out a short-term debt, every time you refinance, relend, you're getting more, fees in. So there is a commercial perspective from a bank to want to do it. But then flip side is, if there's lots of liquidity, the bank, as you say, may be happy with long-term debt and tying up that capital in the bank. So
yeah. And you can see that on long-term debt as well. You will see often a margin structure on long-term debt where the margins ratchet up over time. You have a certain margin for the first few years of operations, and the margin kind of ratcheting up after that. I always kind of thought that's a bit unusual, because actually you kind of feel like, well, project risk is decreasing over time, right? Things have been running for 10 years, it's kind of working. So why would we be ratcheting up the margins? And that's to the same thing that Toby is talking about. It's about increasing the incentive to refinance. And yeah, to Maddie's question, different markets are different. So there's no kind of universal here. And I know in the US, as you say, there's often short-term construction loans and then refinancing and different structures. This is more about where you have a market where long-term debt is kind of more regular.
And I'm just going to say as well, in terms of hard versus soft, in general, people or projects like to have soft mini perms, because if you think the projects are in partnership with a public body, if there's a hard mini perm, someone's got to take that refinancing risk, and who ultimately is going to bear it. So if you've got a hard mini perm where there's a risk of default, someone's got to take that, and the whole purpose of what's a project finance is to get that risk away from the public sector. So generally you will see more soft mini perms than hard ones, just as a general thing of what I've seen in the market. Just as that risk transfer.
Yeah. And Francisco's asking about setting the levels of an interest rate swap for a mini perm, and that's a really interesting question, because the question is, what do you swap, right? Because you have a few different. Well, let's maybe put it back to the group, right? There's 3 different debt profiles in play, right, in your base case model. One is your no refinancing case, where you have the mini perm that the debt sizing case, if you like, no refi, 20-year repayment. That's that's our no refinancing cash flows. Then we have our refinancing debt structure, which has 4 years at a certain level, and then the refinancing happening, either replacement or refinancing, releveraging. And then you have the cash sweep profile, where what happens if we fail to refinance and that cash sweep kicks in? Because when we're placing an interest rate swap, that's going to be placed with reference to a series of nominal cash flows, right? What the debt cash flows that we're expecting, and that's what we use to calculate the swap. And in the CPFM course, there's a whole module about swap pricing and how that works, and we can the little plug for the CPFM course right there. But yeah, which one would you use, and what do you think is the right one to use for placing a swap? And Toby, I'm going to get you to answer it. As a former banker, which one would you expect to be swapped? And then I'll share my experience. Yeah, come on, Maddie. Depends on the market conditions. That's a pop out. Come on. That's
the thing. I'd say it depends whether you end up being in and out of money, and what happens. Do you keep the hedge in place, but then under the refinance debt, you end up with a mismatch? Do you break it? What's the cost at the say if you've got that hedge in place, what's the cost of breaking it at the point you do the refi? You might be in the money, out the money, by how much? Often, could you get a huge sort of uplift in the amount of additional debt you could borrow? These are all factors, as Kenny was saying. You build the model and you run all of your scenarios to say, well, actually, let's have a look at these and try and get through the weeds and work out what happens to our returns and what's the most likely and preferred route. It's not a simple answer, unfortunately.
Yeah. I mean, what we've seen, and I can only talk to what we've seen on recent projects, is generally swapping the cash sweep profile, because that's the kind of lender default profile, if you like, right? And one thing that the lenders will be looking at is how quickly does the debt repay with the cash sweep, right? That's one of the things they'll be looking at. And that swap profile at least covers you until the refinancing date. You wouldn't want to take any view in the swap profile as to what the debt looks like post refinancing, and lenders will want to make sure that you're covered for the cash sweep period in case that happens. So that's generally what we've seen, is that the debt profile used for interest rate swaps with the mini perm is the cash sweep profile. But again, I'm sure maybe other people have different experiences. So do the same lenders refinance the project? Yeah, you'd go out and search for it, Can. And nobody, in my experience, nobody's going to give you, I'm sure they give you nice words about, you will be happy to look at the project at the time. I'm sure they'll give you nice words about it, but they're not going to commit to rates or anything, potentially 5-6 years out. What we sometimes see in bid situations is procuring authorities specifying mini perm uplift. So they might say, assume your mini perm debt is refinance. If you're assuming a refinancing, assume it at 50 bips over your pre-TRD margin, so that they standardize the assumption across all their bids. We've seen that happen, but that's got nothing to do with reality. That's just standardizing bids. So yeah, nobody's going to commit to a refi 6 years out. Guys, these sessions are always too short. Like we're 40 minutes in, and we wanted to have some time for networking because that's part of the what we're doing in these sessions. I'd love to do a dedicated webinar on this topic. It feels like there's a lot of interest. One of the things we do in PFI is kind of put topics out and see what's interesting for people. And, you know, it's great to have so many of you on this session. And, you know, if there's general interest in learning more, getting into the weeds of that modeling and seeing it in real projects, really happy to organize a dedicated webinar where the objective is not to have the networking at the same time and get into the weeds on it. You know, maybe let us know on the platform if that's something you'd want us to do.